So for those of you who don't know, I studied economics at uni, and I've got a keen interest in not only the economy, but also the markets in general. So today is going to be a real treat for me. Our guest today is the well-known economist Saul Eslake. Saul's an independent economist with over 4 decades of experience in Australian financial markets. He's held key roles such as the chief economist for ANZ Bank and the chief international economist at National Mutual Funds Management. From his early days in the Australian Treasury to his tenure at Bank of America Merrill Lynch, he's been deeply involved in the economic analysis and policy making of many companies. Since 2015, Saul has operated Coroner Economic Advisory, delivering keynote addresses, participating in panel discussions, and providing tailored analyses for a diverse range of clients, including institutional investors, corporations, government agencies, and also social organisations. His expertise spans macroeconomic trends from economic growth and inflation to regulatory issues as well, with published research covering various industries and themes including housing, tourism, and regional development. So that sounds pretty technical, doesn't it? But why should you listen today? Well, we're going to dig into all things inflation and interest rates. Now, if you run an agribusiness and interest rates and the cost of doing business keep going up is something you're interested in, then the podcast today will be for you. You know, also, it might just be you want to exercise that grey matter in your head, or you just want to learn some interesting new stuff. Then join us on the journey today. So without further delay, welcome, Saul.
Well, thank you, Ben. It's a pleasure to be with you, and I'm looking forward to the conversation.
Pleasure's all mine, I guarantee. I love this stuff, and I know from my guest's point of view, the feedback we quite often get, Saul, is people love the technical stuff. So the technical stuff that we were going to discuss today, well, some of it might go over people's head, but I think we'll be really down to earth and practical. So where I want to start off with, Saul, is how is our economy going at the moment from an economist's point of view?
Well, there are a number of short-term challenges that the Australian economy is grappling with, and of those, the most obvious, both to economists and to ordinary folk, is inflation, what the media like to call the cost of living crisis. You know, we have been through the worst inflation since the early 1980s in the last 2 years. It peaked at 8.3% over the year to the December quarter of 2022. It's come down to about 3.5% as of the first 2 months of 2024, but that's still considerably above where the Reserve Bank wants it to be. And this high inflation has been hurting ordinary people, partly because wages haven't been keeping up with inflation, with the cost of living, so people are going backwards in real terms. Partly because if you have a mortgage, you know that the Reserve Bank has lifted its cash rate, and therefore your mortgage rate by 4.25 percentage points almost. That's the sharpest increase in interest rates in Australia since the late 1980s. And for about a third of the population who have a mortgage, that's a very painful experience, especially for those who took mortgages out in 2021, taking at face value the words of the then governor of the Reserve Bank that interest rates would remain at record lows until 2024 at the earliest, which they certainly haven't done. And even for people without mortgages, income tax has been taking a progressively bigger bite out of your income, partly because of bracket creep, partly because more people are working and thus earning an income, which is a good thing, and paying tax on it, which is a good thing if you're the federal treasurer and able to say that, contrary to everyone's expectations, you've just brought down the first budget surplus in 16 years and are probably going to bring down another one in the financial year that ends on the 30th of June. So they've been significant challenges. Many people had feared that such a steep increase in interest rates as the way in which the battle against inflation is being fought would take a heavy toll of employment and result in unemployment going up. And, you know, history tells you that that's what normally happens when monetary policy is tightened. That is, when the Reserve Bank jacks interest rates up in order to bring inflation down. Somewhat remarkably, that hasn't happened. Employment growth has slowed a bit. Hours worked have fallen a bit from their peak, but the unemployment rate still remains below 4%. And although it's up from the low of 3.2% we saw in the second half of 2022, for most of the last 50 years, economists and others have thought that we would never see an unemployment rate of less than 5% again, yet here we are with an unemployment rate of less than 4%. Now, that's been the experience of some other countries as well, too. In the United States, for example, where rates have gone up by more than they have done here, the economy there grew by more than 3% last year, and the unemployment rate is still less than 4%. So they've had the softest of soft landings. They've still got some way to go in terms of bringing inflation back to where they want it to be, as do most other countries in the Western world, in Europe, in Canada, New Zealand. They're all dealing with the same challenges that we've been dealing with here. One other factor that's been an important influence on the Australian economy that many hadn't expected has been the enormous surge in population growth, fueled by the biggest immigration wave we've had since the early 1950s. That has certainly made our economy look better than it otherwise would have done. If it hadn't been for the huge surge in immigration, we probably would have had 2 or more quarters of negative growth in real gross domestic product. That's the total volume of goods and services produced in the Australian economy. And the media likes to define a recession as 2 or more quarters in a row of negative growth in our economy. We probably would have had that if it hadn't been for the enormous surge in population growth. But that in turn has brought some other problems with it. It's been a significant contributor to upward pressure on housing costs, particularly rents, and particularly in Sydney and Melbourne, where most of the migrants head for, less so in regional areas. And that in turn has been a contributor to inflation remaining higher than the Reserve Bank wants it to be for longer than the Reserve Bank wants it to remain high. And, we haven't faced that challenge down completely yet. The financial markets have been speculating on the prospect of interest rates coming down in Australia this year. I've been sceptical of that for a long time. I don't think interest rates are going to go up again unless there's some nasty surprise on the inflation front out there that nobody's foreseeing at the moment. But I suspect it will take longer for interest rates to come down than the financial markets and many other economists have been suggesting. That's partly because interest rates haven't gone up here as much as in other countries. They've gone up a lot. No one's suggesting otherwise, but the Reserve Bank's cash rate of 4.35%, as it's been since last November, is lower than in continental Europe, where it's 4.5%, the UK and Canada, where it's 5%, the US, where it's 5 3/8%, and New Zealand, where it's 5.5%. And the Reserve Bank of Australia was later to start raising interest rates than most of its peers in other countries. It didn't start until May of 2022, whereas over the other side of the Tasman, for example, the Reserve Bank of New Zealand started lifting rates in August 2021. The Bank of England started lifting British rates in December of 2021. We were slower to start, and we haven't raised them by as much. To me, it stands to reason, therefore, that inflation will probably come down a bit more slowly here than in some of those other countries. And so, therefore, too, will interest rates. And an additional reason for saying that is that in Australia, most people who are working or earning an income in some other way are going to get income tax cuts starting on the 1st of July, that in total are the equivalent of 2 25 basis point reductions in the Reserve Bank's official cash rate. Now, the benefits of that are going to be distributed differently across households than the impact of 2 rate cuts, but the Reserve Bank isn't fussed about that. What it's concerned is the impact of that on aggregate household spending, and it will be a stimulus of sorts to aggregate household spending. So, why, when inflation is still likely to be well above where the Reserve Bank wants it to be when those tax cuts take effect, why would the Reserve Bank be doubling up on their impact by cutting interest rates as well? I don't think rates are going to start coming down in this country until February next year.
That's interesting, because I sort of sense the same just from a common sense point of view, Saul, and we'll get into interest rates a little bit deeper in a few minutes. But my sense, just to make a statement rather than a question, is that all the factors are saying, like, unemployment's so low, the economy's still ticking along, inflation's high, property prices are going up. It just doesn't make common sense to me to see that the government would start pushing interest rates down at this stage. It just doesn't make any sense.
Well, I think that's right. And, that's not to deny that a lot of households, a lot of ordinary folk really are feeling the pinch. Real per capita household disposable income, that's income after taxes and adjusted for increases in the cost of living, has over the last 6 quarters, the last 18 months, fallen by more than at any time since the recession of the early 1980s, which was accompanied by one of Australia's most severe and protracted droughts as well. So households are, to use the phrase politicians like to use, doing it tough all over the country. But important as consumer spending is, it's only 60% of the economy, and other bits of the economy are actually doing reasonably well. Business investment is holding up pretty well because businesses are investing in, for example, the transition to renewable energy. They're investing in digitising their business, in part because of the rapid changes in the way that business is done that occurred during COVID and are now occurring as a result of the spread of artificial intelligence, or AI, as it's called. These require some significant capital expenditure commitments by business, which businesses are making, even though business confidence is down a bit because of the increase in interest rates. Exports are doing reasonably well. And state governments are spending an awful lot of money, most of it borrowed, but they're spending an awful lot of money on infrastructure projects around the country. So that other 40% of the economy that isn't household spending is actually doing pretty well. And even though household spending is weak and households have been doing it tough, overall the economy is, under the circumstances, not doing too badly.
How's that comparing to places like the US or Europe? Would you say, from an overriding point of view, is it a very similar story in those countries? And I get the fact that, Europe's manufacturing, US is a different market, but are they sort of suffering or having the same sort of outcomes over there?
Well, the US has done surprisingly well. This time last year, in the early months of 2024, every man and his dog, including the Federal Reserve, were saying that the US was likely to experience a recession. And it's actually unusual for the central bank of a country to forecast a recession, not least because if one happens, people will then accuse the central bank of talking the economy down and making a recession more likely. So they don't normally do that. But this time last year, it was widely expected that the US would experience a recession as part of the price to be paid, as history tells you it would normally be, to bring inflation down from unacceptably high to tolerable. And yet, during 2024, the US economy grew by 3.1%, and the unemployment rate stayed below 4%. And that was despite the fact that the US hasn't had anything like the surge in immigration and population growth that Australia has had. Some of that was because of the fiscal stimulus that the Biden administration has imparted to the US economy during 2023, in particular through what the Americans have called the Inflation Reduction Act, which has had actually nothing to do with reducing inflation, but rather has been the vehicle for providing a whole lot of subsidies to manufacturing industry in particular, and which the Australian government now seems to be wanting to emulate, albeit on a smaller scale. That's been a source of additional economic growth to the US economy, which is being put on the tab. It's all being done with borrowed money. The US budget deficit is over 6% of America's gross domestic product. That's big. And at some point, there will probably be a reckoning for it. But because the US dollar is still the world's principal reserve currency, and there is no obvious alternative to it on the horizon, the US can get away with running budget deficits that are bigger than other countries for longer than other countries can do without suffering the consequences that Australia might if we were to run budget deficits of 6% of our national income for 10 years in a row, as the Americans look like doing. So some of that growth that the Americans have recorded is perhaps borrowed from future years. But if you look elsewhere in the world, the UK is in what they call a technical recession. They've had a couple of quarters of negative economic growth. Some other continental European countries have had the same. New Zealand has had 4 quarters in the last 5 of negative economic growth, and their unemployment rate has gone from 3.2% to 4%, and it would have gone higher except that New Zealand has a safety valve in these circumstances that we don't, which is that New Zealanders can come here and look for work. And New Zealanders have been part of that surge in immigration to Australia that I mentioned before. If all those New Zealanders had stayed in New Zealand, their unemployment rate would have been even higher than the 4% it is. But even though, as I say, New Zealand and continental Europe, and for that matter, Canada too, which is in many ways more like Australia than any other economy on the planet, except we don't often think about Canada because it's a long way away and we tend to think of it perhaps as a subsidiary of the United States in the same way that some Australians think of New Zealand as being almost a part of the Australian economy. But, Canada has seen a significant rise in its unemployment rate. It's also had a surge in immigration, but immigrants to Canada seem to have had a tougher time finding work than immigrants to Australia. So Canada's probably pretty close to a recession as well. But around the world, it's striking that in the face of mild recessions and higher interest rates, employers are still inclined to hang on to their workforce more than they would historically have done during economic downturns. And yes, unemployment's gone up in the UK and in some continental European countries, but not as much as you would have expected. And I think the reason is that employers were in some way burned by their experience as we came out of COVID, that they found it difficult to get the labour they needed to do the business they wanted to do and to meet the orders that they were receiving from their customers. And so now I think employers are saying to themselves, yes, our profit margins are being squeezed, but this isn't going to last forever, and we're not going to let go of workers that we've struggled to find. We might reduce their hours and reduce our wages bill in that way. And employers have more flexibility to do that now than they have done in generations gone by. But employers do seem to want to hang on to their workers because they know that they will need them when eventually interest rates fall and economic activity begins to pick up.
What about China? There's been a fair bit in the news recently about the reduction in iron ore price. There's a whole lot of minerals that have dropped in price substantially. How do you think that's going to impact things over the next few years? Because I would assume that would be probably one of our greatest risks. Is that right? Or are we a bit more insulated than we used to be?
We're certainly very exposed to what happens in China. Australia is now more dependent on China as a market for our exports and as a source of our imports than we have been on any country since the early 1950s, when most of our exports went to and most of our imports came from what in those days we still used to refer to as the mother country, that is the United Kingdom. And it also used to be the case that although we weren't and never has been as dependent on the United States as an export market as we have become on China, nonetheless, when America sneezed, we got a cold. And a lot of that was transmitted through the financial markets because our financial markets still do very closely follow what happens in the US, even though the structure of our economy is very different from that of the United States. But what happens in China matters to Australia. And, we saw that when China sought to coerce Australia through slapping bans and tariffs on imports of a wide range of products, most of which were agricultural. Now, it's a testimony to the agility of a lot of Australia's agricultural and other exporters that, with the exception of wine, they were able to find alternative markets for products that were slugged by the Chinese, such as barley or meat. That Australian exporters found alternative outlets for that. Some of our so-called allies, France, Italy, Spain, the United States, were happy to cut our lunch in the Chinese market when it came to wine, and it will be difficult for Australian wine exporters to recover all of the territory they lost during that period in China, in part because Chinese importers have now signed contracts with some of our competitors in the wine industry that will, outlast. Most of those problems have now been resolved in the bilateral relationship, but we know that things could turn south again. China's economy, I think, is going through a substantial transition now. We've kind of gotten used over the last 40 years to think of China as growing much more rapidly than the rest of the economy and becoming not rich, but, achieving middle income status remarkably quickly by comparison with other countries who've gone down that path in the past. But that's now starting to change. China's population is shrinking. And its working age population is shrinking even more quickly because of the lagged effects of the one-child policy that was pursued from the late 1970s until about 5 years ago. And, China's gone almost as far as it can go in moving its population out of subsistence agriculture in rural areas into more sophisticated manufacturing and services industries in what are very big cities, in urban areas. China has backed away from some of the economic reforms that were the hallmark of the 1980s, 1990s and early 2000s, and under Xi Jinping, who's putting much more emphasis on security than on economic growth. State-owned enterprises are assuming a bigger role in the economy again than they had done over the previous 20 or 30 years. Xi Jinping's government is much more reluctant to respond to slower economic growth by launching big fiscal or monetary policy stimuli than previous governments have been. That's not to say that they're doing nothing, but my view is that China's economy is now likely to grow by less than 5% per annum, and indeed probably over the second half of this decade by less than 4% per annum compared with the 10% per annum that China recorded between 1979 and 2010.
And sorry, Saul, just to put that in, I can remember 10 or 12 years ago when China was saying, look, our growth rate might be somewhere around 8 to 9%, and everyone started having a complete panic that China was slowing down. So talking about 4 and 5% is a big change, isn't it?
Right. And, this has been of enormous benefit to Australia. There is no other Western country who has derived so much benefit from the rapid growth and industrialisation of China between about 1979 and 2015 than Australia has done. For most other so-called advanced economies, which are exporters of manufactured goods and importers of commodities, China's emergence as the world's biggest importer of commodities and exporter of manufactured goods has actually been a negative, because it's forced countries like Japan and continental Europe to pay more for the commodities that they import, whilst undercutting the prices of the goods that they export, or indeed cutting them out of those markets altogether. But we in Australia, unusually for a so-called advanced economy, are an exporter of commodities and an importer of manufactured goods. So China's emergence as the workshop of the world has not only created enormous demand for commodities that we export, but it's also forced the other traditional importers of those commodities, like Japan and Korea, to pay higher prices for the things that we still sell to them, whilst also given Australian consumers access to a much wider range of cheaper and generally better made manufactured goods than we had access to in the era when, in the guise of pretending that we were good at manufacturing, we forced Australians to pay excessively high prices for things like motor cars and textiles that were often badly made and would break down or wouldn't last for as long as intended. So, we've derived enormous benefits from that. And Australia has been one of very few Western nations or advanced nations that has run trade surpluses with China. That's in part why China was able to block some of the exports that we make to China, because we actually export things to China. They couldn't have done to the UK or the US what they did to us because they don't buy much stuff from the UK or the US. Now, the fact that China's economy is now, I think, in a long-term slowdown means that we do have to look for alternative markets, because China isn't going to be the source of growth that it has been. I mean, the iron ore prices held up remarkably well in the face of the collapse of China's property markets. And, people have thought that because property construction uses a lot of concrete and steel, and that's now going southwards, the demand from China for coal and iron ore would fall away. It has a bit, but for example, the Brazilian iron ore industry has been in considerable trouble since that series of tailings dams disasters about 8 years ago, and their production hasn't recovered to where it was before those disasters happened. So we've got a bigger market share than we already had. That's helped us. And while China might not be using as much steel in property construction as it used to, they're using an awful lot of steel in their now more rapidly growing manufacturing sectors, such as electric vehicles, where they have come to dominate the world. And so probably the demand for steel, and hence for iron ore and coking coal will hold up some for the rest of this decade. But eventually, Australia's going to have to cope with the fact that the escalator we've been on since the early 2000s, thanks to China, of elevated prices for our mineral and energy products, is probably going to go away. Now, there'll be some other minerals, commodity exports that we're blessed with, lithium, copper.
Well, Tesla gets most of their lithium from Australia, I heard Elon Musk say the other day.
Indeed. And we are the world's biggest exporter of lithium ore. We're not so good at processing spodumene, as it's called, into lithium metal, although we're making some inroads into there. We have some other significant resources of other critical minerals like tungsten and titanium that will play a bigger role in the zero carbon economy. But China has its foot on a lot of those as well. And the other major source of some of these critical minerals like cobalt and vanadium and magnesium and so forth are in rather politically unstable countries in Africa.
What they call conflict minerals.
Correct. But China has fewer qualms about investing in those countries than Australia or the United States or European ones do.
Absolutely. So inflation, at the moment, where are we right now, roughly?
Well, the inflation rate in January and February of this year, which at the time we're recording this are the latest available, has been between 3.5% and 4%. Now, that's half of what it was at the peak. It was 8.3% over the year to the December quarter of 2022. So we've certainly gone in the right direction. But 3.5% to 4% is still a long way north of the 2 to 3% that the Reserve Bank is tasked by the federal government with getting inflation down to. And once it's gotten it down to there, keeping it within that range.
Because that's what most farmers and graziers are worried about these days is number one is interest rates and number two is the cost of everything going up. So the big ones are fertilizer, fuel, electricity, energy, and they're the major ones. So, and obviously, the inflation rate coming down means that across the board, the cost of everything should be normalising. It still doesn't mean they go down. It just means they only rise by 2 to 4% a year.
Yeah, no, that's absolutely right. I mean, there might be some relief from rising electricity prices in the second half of this year. The huge rises of more than 20% that have occurred over the last year were largely driven by the surges in prices of coal and natural gas in the aftermath of Russia's invasion of Ukraine. And those big increases in the raw materials for electricity production in Australia have now more than reversed themselves. Unfortunately, the wholesale price of electricity and gas only accounts for about 1/3 of the retail price that farmers and households pay for their electricity. The other 2/3 are in what are called transmission and distribution costs, that's poles and wires, and in the costs of operating the retail electricity businesses that farmers and householders pay their electricity bills to. And their costs aren't coming down. And the cost of building poles and wires, especially as we transition to a zero carbon economy, given that the places where the sun shines and the wind blows are typically not the places where the coal mines or the coal-fired and gas-fired power stations happen to be sitting. So there's an enormous amount of investment required in poles and wires, and someone has to pay for that in the end, and ultimately it's going to be electricity consumers. But if there is some good news on the inflation front there, it is that there shouldn't be any significant increase in retail electricity prices this July when they reset. And it's not impossible that there could be some small falls. So at least in that area, if not in some others, there's a bit of good news on the horizon.
Yep. So let's get into interest rates now, Saul. I mean, I know someone said to me one day, they said, Ben, if you get 4 economists in a room, you're going to get 4 different opinions. and I couldn't agree more. You like trying to predict the weather in many cases, but most rural producers carry a lot of debt and most are asset rich, cash flow poor. So they're very sensitive to interest rates. So have you seen a time in history economically that's very similar to where we are now to sort of give us a guide of where we might be going over the next few years? Because what I'm trying to get a sense of is you said that, I think from memory from the beginning, is maybe early part of next year we can expect some reductions. But are we going to see continued reductions or do you think a levelling out? So is there a historical time that you can match it with? And where do you think rates are going to head over the medium term?
Well, I'm 66, so I've lived through periods when interest rates have been much higher than they are now.
Yes. I remember them in the 80s.
Yeah, I mean, I paid 17.5% on the mortgage on my first home for part of the time that I had it. So now if you're still paying the standard variable rate, that's 8.77%. Most people are able to do better than that with their variable home rate loan. Business loan interest rates, if they're not secured by a principal residence, they tend to be a bit higher than that. This has been the sharpest increase in interest rates since the 1980s. And of course, there are many people in business today who weren't around, or they might have been kids then, but in their lifetimes, this will have been the sharpest increase in interest rates that they've ever experienced, even though interest rates are nowhere near as high as they were in the 70s, 80s and early 90s. It's nonetheless a painful experience, especially for those who, as I said before, took at face value the Reserve Bank's assurances during COVID that rates weren't going to go up at all until 2024 at the earliest. So that's been a shock. And a lot of people, believe the governor of the Reserve Bank when he or she says something. I mean, after all, they can assume, well, they must know a lot more about this than I do. So
why did they get it so wrong? I get we've got to cut everyone a bit of slack because they look at the data and things change. We have wars, there's black swan events. But it seems to me they did get it so wrong. Why do you think that was?
Well, let me take that in two parts. Every central bank in the developed world, Australia, New Zealand, Europe, the UK, Canada, even Japan to some extent, where over the last 20 or 30 years, the problem in Japan has been deflation rather than inflation. But they've had a bit of inflation in Japan in the last 2 years as well. So every central bank in the world was surprised by the speed with which inflation picked up as we came out of COVID. And some of that was because they didn't fully appreciate the way in which supply chains had been disrupted by COVID. They didn't fully appreciate the enormous spending power that households had accumulated during COVID when governments, on the one hand, threw billions of dollars at households and then came up with ways of preventing them from spending it. So when all those restrictions were dropped as COVID came to an end, there was just a tsunami of spending that people hadn't foreseen, hadn't anticipated. So,
well, everyone wanted to get out, didn't they? They wanted to get out, go on holidays, buy that new thing.
Absolutely, buy stuff. And so, farmers will readily understand this. Demand goes up, supply goes down, prices go up a lot. And that's a big part of the story. On top of that, of course, was the surge in energy prices and prices of some food commodities like wheat and prices of some farm inputs like fertilizers, which, we didn't know that we were as dependent on Russia and Ukraine for some of those things as we found out that we were in the aftermath of Russia's invasion of Ukraine. So that surge couldn't have been anticipated. You can't blame anyone for getting that wrong. But initially, central bankers dismissed that surge in inflation as being transitory and thought it would go away. Now, some of it actually has gone away, but a lot of it persisted. And companies, businesses who had spent the last 20 years thinking that they couldn't raise their prices because if they did, their competitors wouldn't, and so they'd lose market share, and instead had therefore been focusing on relentlessly searching for reductions in costs. All of a sudden discovered in this environment where demand was much higher than supply that they actually could pass on cost increases. And so they did. And in some cases, not many, but some, businesses thought, well, we can not only recover an increase in our costs, but fatten up our profit margins as well. The airlines did that. Insurance companies have been doing it. I don't think supermarkets have been doing it on quite the scale that they have been accused of doing it, but there's been a bit of profiteering in that sector as well. So that all came as something of a surprise. And Australia's Reserve Bank was no different from the Federal Reserve in the US, the Reserve Bank of New Zealand, the Bank of England, and all the others in being surprised by that.
I found that actually with builders. So I talked to a lot of builders over that time, and what a lot of them said is we are massively putting up our prices because we're so scared that by the time we deliver that product, the inflation cost increase in, say, PVC pipe or cement or bricks or whatever was raising so quickly that they just said we have to put our prices up quick and fast fast and higher than we expect them to be able to protect ourselves from inflation. And some managed to do that, and some managed to go broke over the whole time. So I think that's not to blame builders.
Because they had fixed price contracts, yeah.
Yeah, and it's not to blame builders. It's just like you could see that panic in people that if we don't put our prices up now, by the time we deliver those goods, we're going to be making a loss.
Right. And another factor in that, which you've just reminded me of, is that no one foresaw the surge in migration that occurred when we opened COVID. I mean, something I was wrong about was that I actually thought during COVID that our fairly brutal and callous treatment of our own citizens during COVID who found themselves stranded overseas and, weren't allowed to come back at all or weren't allowed to come back for the funeral of their parents. This was pretty brutal, callous stuff that most other countries didn't do to their own citizens. I actually thought that might have some lasting impact on Australia's brand as a desirable place for immigrants to want to move to. But I was wrong. It hasn't had any impact at all. And so this surge in migration, which no one foresaw, and I don't think anyone could have foreseen, has had a big impact on rents and house prices, which in turn have gone into inflation. It's been a major contributor to inflation from a source that no one could have foreseen. But, as I was going to say, the uniquely Australian contribution to this was to put a date on it. Most other central banks said during and initially after COVID that they would keep interest rates at record lows until some certain economic targets had been met, such as inflation, which, for the last 6 years in most countries before COVID was too low rather than too high. They wanted to keep interest rates at record lows until inflation had returned from below to its target range and that unemployment had come down from its COVID-induced highs. But they didn't put dates on it. The Reserve Bank of Australia was the only central bank in the developed world that put a date on it, saying, rates are going to stay low until 2024 at the earliest. And the Reserve Bank kept saying that until November 2021, which was after some other central banks, like the Reserve Bank of New Zealand, had already started to raise interest rates. So that was, I think, a uniquely Australian mistake that didn't have to be made. And, of course, that's the reason why the governor of the Reserve Bank who repeatedly said that, Dr. Lowe, isn't the governor of the Reserve Bank anymore. Unlike his two predecessors, both of whom got extensions to their 7-year terms, Phil Lowe didn't. And I think that's the reason why.
So, Saul, I talked about this with someone the other day. Back when I studied economics at uni, they talked about, to simplify it down for me when I was a 17-year-old uni student in Economics 101, was essentially we got to in the economy where interest rates were the accelerator to the economy. So if we lower interest rates, we put the foot on the accelerator. We raise interest rates, we're putting our foot on the brake. But in the middle, there's this beautiful spot where the economy just coasts along and it's not an accelerator, it's not a brake. Where would you expect, from an economist's point of view, where's a normal level that they're not either stimulatory or they're not also putting the brake on the economy? Have you got a sense of where that is? Because I think people struggle with the fact that we don't know where rates should be to be able to look into the future. Should it be 5 or 6%? Should it be 8%? Should it be 2%? What's your sense of that?
Well, I don't want to unnecessarily scare your listeners, but central banks don't know that either. And they're the ones who set interest rates. There's an enormous literature, some of it written by people in central banks, some of it written by academic economists in universities, some of it written by people like the ones I used to be, economists working for commercial or investment banks, trying to figure out where what is sometimes called the natural rate of interest, or in some of the economics literature, it's called R star. A little r with an asterisk above it, the rate of interest at which monetary policy is neither stimulating nor restraining growth. And one complication, of course, is that nobody actually pays or receives the cash rate that the Reserve Bank sets. It's minus 10 basis points. It's the rate the Reserve Bank pays on the balances that the banks hold at the Reserve Bank, and plus 10 basis points what they charge on any overdrafts that the banks might have at the Reserve Bank, though that doesn't happen very often. But, you and I don't pay the cash rate. What we pay if we have a loan, a mortgage, is a rate which is some margin above the Reserve Bank's official cash rate.
And for farmers, that can vary depending on their...
Right, yeah, exactly. That margin isn't constant. So one of the things that central banks have to be conscious of in thinking about what is the so-called neutral rate of interest is what's the difference between their cash rate and the rate that borrowers are actually paying, because that's what matters. The second thing is that What matters are so-called real interest rates. That is to say, not if the cash rate's 4%, but inflation is 6%, then the real interest rate is -2, and you're actually, in a sense, being subsidised to take out a loan. If you think that inflation is going to remain at 6%. That's one reason why central bankers pay a lot of attention to inflationary expectations, what people think the rate of inflation will be in the future, because that affects their calculations as to how painful the current level of interest rates is. If by contrast, the cash rate's 4 and the inflation rate is 2, then that's a real interest rate of +2. So you have to think about what the inflation rate is going to be in that. And then the third thing that influences it is how much debt is there in the economy. If there's a lot of debt in the economy, then
we're far more sensitive.
And it also matters how that debt is structured. So in Australia, almost all mortgages are at variable rates. And that means that when the Reserve Bank lifts the cash rate and the banks pass that on immediately to their customers feel it much more quickly than in the United States, for example, where almost all mortgages are at rates fixed for 30 years. Or even over in New Zealand, where fixed rate mortgages typically mean between 1 and 3 years. Nonetheless, more New Zealanders have fixed rate mortgages than variable rate mortgages, so it takes longer for changes in the Reserve Banks of New Zealand's cash rate to influence the New Zealand economy than it does for changes in the Reserve Bank of Australia's interest rate to impact the Australian economy.
Both positive and negative.
Yeah, and that's one reason why the cash rate in New Zealand is 5.5 as opposed to our 4.35, because they have to do more in order to have a given impact on the economy than the Reserve Bank of Australia does. And that makes monetary policy much more political as well, because, in the United States, when the Federal Reserve meets, the outcome of that meeting is not the first item on the 6 or 7 o'clock news. It's not on the front page of the paper that people read, if they still read the paper, on the train on the way to work, whereas here in Australia it is. Because when the Reserve Bank meets and changes the interest rate, we feel it. If we have a mortgage or a small business loan, we feel it the day afterwards almost, or the week afterwards, whereas in the US they don't. And in most other countries where mortgages are at fixed rates, they don't. It doesn't matter to them. So all of those things feed into the calculations that people try to make as to what is the long-run sustainable rate of interest. Taking all those things into account, the Reserve Bank used to think that the natural rate of interest for the cash rate was about 4.5%, which in turn would have meant that the mortgage rate, which used to be about 250 to 300 basis points, 2.5 to 3 percentage points above the cash rate, would be about 7.
Because I remember my economics professor back at uni, they used to talk at between 6 and 7% was the natural rate back then.
That's right.
And that was 20-something years ago.
Right. Now, partly because households have so much more debt, the natural rate of interest is probably somewhere between 3 and 3.5. At one point towards the end of the past decade, just before COVID hit, and we had 5 years in Australia and longer in most other countries of inflation being too low rather than too high. And it's easy to forget that now, but for the 5 years leading up to COVID, Australia's inflation rate had been under 2. Central bankers were starting to think maybe the natural rate of interest was close to 0, in which case, not the rate of interest that people pay, but the rate of interest that the central bank set was close to 0, which is a real problem, which is what do you do if you have a recession, given that it's very hard. I mean, some central banks did do it during COVID, have negative interest rates, but banks didn't charge negative interest rates, and they probably never would. Banks didn't charge negative interest rates on deposits either. So there probably is a 0 lower bound for interest rates. And if the natural rate of interest was for a central bank was going to be close to 0, that might mean monetary policy didn't work anymore. And we'd have to go back to using fiscal policy, which of course we did during COVID in particular. Fiscal policy budget policy played a much more important role in getting economies through COVID than monetary policy did. But, now that we're back in an inflationary environment and, we're probably not going back. I hope we're not going back to a period where inflation is persistently too low. That's no more desirable than inflation being persistently too high.
This is the thing a lot of people don't understand. Why is low inflation a problem? If the cost of everything not going up every year, why is that a problem for an economy?
Because it makes it much harder to reduce costs in real terms if the general level of prices isn't moving very much. So, for example, let's say you're an employer and business conditions are a bit tough and you need to cut your wages bill or at least stop it going up. Now, if inflation is running at 0 or 1, the only way you can do that apart from sacking workers is to cut their wages. And that's an incredibly difficult thing to do. I mean, you can in some ways, I suppose. Well, I mean, if most of your staff are working part-time, you can reduce their hours. But otherwise, it's very difficult. Whereas, if inflation is 3, you can give your workers a 2% pay rise and they'll probably accept it if they think the alternative is losing their jobs. But you've in effect, in those circumstances, reduced your real wages by 1%. So a modest rate of inflation, 2 to 3, that most people won't notice, that won't have a significant impact on the decisions they make. Gives individual businesses a bit of flexibility.
So it's a bit like a little bit of a shock absorber. Is that a good way of putting it?
Yes. Yeah, that's right. And the other thing is that, there would be a cost to be paid in keeping inflation at 0 in the form of higher unemployment. There's a trade-off in economics. I'm sure, I was taught about this when I was doing first, second and third year economics. And there's a trade-off in some circumstances between inflation and unemployment. And, the burden of unemployment is unfairly distributed. If unemployment goes from 3% to 7% and you're not one of those 4% of the workforce who loses your job, it doesn't affect you much. But if you're one of those 4% of the workforce who does lose your job, it affects you a great deal.
It's funny, Saul. I remember someone saying to me once, they said the difference between a recession and a depression. A recession is where someone else loses their job. A depression is when you lose yours.
Yeah. And so in some cases, you might say an increase in unemployment is an unavoidable price to pay for getting inflation down from where it's been to where we want it to be. We've actually managed that pretty well in Australia here, as they have in the US, in that we've got inflation down, not quite to where we want it to be, but a lot closer to it than where it was, without having to pay a high price in terms of rising unemployment. The price instead, I suppose, if you like, is being paid by people with a mortgage. They've paid the price. Or people with business loans have paid the price of getting inflation down.
It's interesting, Saul. One of the things I find is that it's such a blunt instrument because when interest rates go up, it disproportionately affects the young and the indebted, the younger people getting on the property ladder, and also business owners that take on debt to expand. When interest rates go down, so basically property prices go up, and so it disproportionately affects those people as well. And I think that's why we talked about the balancing act of fiscal policy, which, correct me if I'm wrong here, is essentially government policies, and then monetary policy is essentially interest rates. And the two of those put together.
That's right. And, it's kind of interesting. I've had people ask me in the last year or so, aren't there other ways of getting inflation down than putting interest rates up, which do, as you say, disproportionately impact people with mortgages and people with business loans? And the answer is yes. People with longer lifespans than mine, or people who've read their history, will know that in the 50s, 60s and early 70s, interest rates weren't the principal means of responding either to inflation or to recessions, but rather it was budgetary policy, in particular taxes. So if you go back to the highest inflation Australia's ever had, which was 23% in the aftermath of the Korean War wool boom in the early 1950s, right? The Reserve Bank, which in those days was under the control of the government, didn't put interest rates up. Rather, the Menzies government, through Treasurer Artie Fadden, who was from Toowoomba, he was the leader of what was then called the Country Party, he brought down what became known as a horror budget, which imposed a 10 percentage point surcharge on income tax paid by both individuals and companies, lifted the rate of wholesale sales tax from 8.5% to 12.5%, said that companies had to pay their quarterly tax instalments, as they used to in those days, 1 quarter early. And Artie Fadden said after that budget that he could have fitted all of his friends into a phone booth.
And there would have been space.
Indeed. And, of course, nowadays a lot of people wouldn't know what a phone booth was, but in those days, they were ubiquitous. And although that was never done on quite that scale again, on a number of other occasions in the early 60s and in the late 1960s, governments would, impose surcharges on income tax or give rebates of income tax or increase rates of sales tax or reduce them as a way of dampening or stimulating demand in order either to bring inflation down or to bring unemployment down. But they don't do that anymore.
It would be very politically popular or unpopular, wouldn't it?
Well, yeah, it's political, but they're also, in order to change tax rates, you need to get legislation through the parliament. And these days, you can't guarantee that that's going to happen, because governments don't usually control the Senate. But it also requires politicians to accept responsibility for decisions that make people worse off. And politicians are very reluctant to do these days. It's much easier for the Treasurer to say, I feel your pain, but don't blame us. It's the Independent Reserve Bank that did that. Now, there are advantages to having monetary policy respond to inflation because you can do it quickly. In contrast to how long it would take to impose a 5% surcharge on income tax, for example, you'd have to fly all the politicians back to Canberra. You'd have to get legislation drawn up by public servants and then presented to Parliament. And
there's probably high court challenges and all these sorts of things that had happened.
Right. And the legislation these days might not get through. So, monetary policy is a much more agile instrument for dealing with inflation. There's a downside. As I say, its impact is in many ways unfair on people who have mortgages and people who have business debts, but that's the way the cookie crumbles nowadays in our political environment. And again, Australia's not unique in this respect. This is the way it works in every advanced economy and most developing economies, perhaps with the exception of China.
It's the law of unintended consequences. Whatever action you take, there's always going to be unintended consequences that either you won't know or you won't have realised will happen, or that you do know what will happen and you can't control.
Indeed. Absolutely.
Okay, look, that's fantastic, Saul. Well, look, I could talk about this all day, mate. So we're starting to get to end of our time. So from your point of view, just to clarify, you think that rates will probably start to look to go down, most likely, depending on, there's a huge amount of factors, possibly early next year. And we're not going to see too much fluctuation after then unless some black swan or some major event happens. Is that a fair summary?
That's right. And look, partly because of part of our conversation a few moments ago, you don't rule out black swans.
No.
They are out there.
And every time in history there's been a big economic change, it's because of a black swan event. I mean, look at Russia, Ukraine. Yeah, you look at what's happening in Israel now, and you've got the Suez Canal and things like that being blocked off in different areas.
And who knows, if Donald Trump wins the US presidential election, perish the thought, I would say. Not that I normally have strong views about, who ought to win American elections, but I'm horrified at the thought that the Americans could return Donald Trump to the White House. And, like people all over Europe and Asia, I'm terrified at what the consequences for us might be if the American people were to be so unwise as to put Trump back into the White House. But, putting those things to one side, I think interest rates will remain where they are for this year. They will start to come down in February, but the cash rate will not go back to where it was before the Reserve Bank started. And remember, it went to where it was because we were facing the threat of the biggest downturn in the economy since the 1930s. So hopefully we won't be there. I would expect the cash rate to fall from 435 maybe to 310 or possibly 285, but no lower than that.
Yeah, that's still a fair drop from now. I mean, if we go from 435 to 310, that's a fairly significant drop, especially for farmers and graziers.
Right. But remember, though, that will only happen because inflation has gone down from 3.5 to 4 to 2.5.
Yeah, I appreciate that. And just from the farming community that are obviously business owners and carrying significant amounts of debt, that can have a massive impact on their situation. So it's a positive, very positive story for them. But I want to say this very, very clearly. The world is a very complex place. The economy is very complex, and we're very sensitive to all things that go on overseas, and that could have a trigger event or a flow-on effect that we don't understand that could change that.
And look, that's especially true for farmers because most of what they produce, unless they're in, say, the vegetable business, most of what they produce is exported. And so the price that farmers get for what they grow or produce is determined in international markets, not by anything that they can do themselves individually. They can affect the quality of their product, and they do, but they have almost zero influence over the price that they get for it.
Yeah, we're very sensitive to the rest of the world and unfortunately, in many cases, price takers. So, yeah, but that's the world we operate in. So, Saul, mate, I've loved that. That's fantastic. You've given us a whole heap of information. I reckon everyone that's listened today will have learnt a whole lot. Where can people find more about you online if they want to, Saul?
Well, if they want to, and I certainly appreciate anyone who does, they can go to my website, which is www.saul-eslake.com, or there's one called Saul saul-eslake.info. They're both the same website, but just pinning a couple of things down. And on that, you can find articles I've written, radio and TV interviews I've done, presentations that I've given, and if you really want to contact me and get me to do some work for you, which I welcome, there's a way of doing that through the website too. Or I'm also reachable on LinkedIn.
Yes, which is where we connected with each other. And I know you've said you've done a fair bit of work with the GRDC,
yes,
providing economic updates to all their members. So if any organisations, etc., agricultural organisations, are someone looking for someone to come and talk or present on economic updates, Saul is definitely your man. And we're really great to have you on the Financial Blokes podcast, Saul. Now, one last question I want to give you before we head off today is my time machine one, which I like to ask everyone. Saul, if you could go back in your time machine, go back to your mid to late 20s and have a conversation with young Saul, what's the one key bit of advice you'd give him?
Well, I've been thinking about that, and there's only really one thing I regret about my life. I've had a really good life, and, I've been fortunate in many ways with the jobs I've done, with the people who've been good to me, with the advice that I've been given by others. And, starting with, I don't make any secret of this, I'm an adoptee. So I was incredibly lucky not to have been raised by my biological mother and instead to have been raised by the people who brought me up and took me to Tasmania and gave me a name and an education. So there's been an awful lot of fortunate things that have occurred in my life. The one regret I have is that I've never lived and worked overseas. Well, I did live for 8 years in England when I was a kid, but that was a kid. I've never had the privilege and opportunities that come with living and working in a foreign country. And I wish I had. There had been a couple of times when the opportunity to work overseas had come my way and I didn't grasp it with both hands. And so, the advice I might have given to a young Saul was, if those opportunities come by, take them.
Yeah, I think that's some sage advice.
There is so much that you can learn about the human condition from experiencing it in a different culture. Even if it's an English-speaking one, like the United States or Britain or Canada, they're different countries from us. And the insights you would get from living and working in a different culture with different people, even perhaps more so if it's speaking a different language or having a different culture, would be something that I feel I've missed out on. And I wish the younger Saul had taken up an opportunity to experience that as part of his life.
Yeah, that's beautiful. I spent a year over in London working for a hedge fund, which was a huge culture shock for me, coming off the farm, going to uni, and then ending up in the centre of London, suit and tie for a hedge fund. And I can tell you it was a great experience. But I think that also the little bit I'd tack onto that, Saul, is I saw a quote recently that was something along the lines of, if you're consistently looking for problems in your life, you'll find them. You will find them, but you'll also miss the opportunities. And I think that's what I'd probably say to young people these days is, there's problems in the world. We talked about a lot of those today, but there's also a huge amount of opportunity. So make sure you keep your eyes open for those opportunities.
I mean, there's another variant on that, which I sometimes say to my own kids, not that they take much notice, is, you can be part of the problem or you can be part of the solution.
Yeah.
And I think the answer to that's obvious, but not everyone sees it the same way.
No, that's a little bit of experience, I think, too, Saul. Perfect. Excellent. Well, look, thank you so much for today.
Been a pleasure.
I've learned a lot. I'll be putting this out in the episode soon. And we'll love to have you on again if you'd be open to it, Saul.
I would absolutely love to do it again, Ben. It's been a pleasure this time.
Well, that was a great episode. I really enjoyed chatting to Saul. Now, one thing I want to be really clear in this is there is no financial advice in this episode. It was just general information. You should not act on anything you heard in there about interest rates and make any decisions in your business without getting advice. It's general information. And also, too, markets move, economies move. What Saul said right now is probably right. 6 months from now, it might be completely different. So it's for information and education purposes only. Now, if you really enjoyed the episode, we'd love